Hello friends, welcome you all to the next lecture of the JC eConnect series of online lectures. In today's lecture, we will be studying Module 4, Part 1, which is about your financial statements, that is profit and loss statement or income statement and balance sheet. So before going to the core, let's discuss briefly upon construction accounting. So in general, what is accounts? It is the maintenance of the money either spent or received is in short termed as accounts. Okay, there is an accounts department in each and every company which deals with the inflow and outflow of money. So with respect to construction industry, construction accounting plays a very important role. It is involved in collecting, organizing, recording and reporting the financial data of a construction firm. It helps in identifying from where the funds are coming and where the funds are going. It also allows to make and systematic arrangements of the funds. Okay, and financial reporting gives us and record where the funds or where the expenses are occurring. So financial data relates to assets, liabilities, net worth, cost incurred, revenue earned, etc. So understanding of construction accounting for a construction manager is very important. Further, to have a better knowledge of construction accounting, we have to study two account statements, which are income statement and a balance sheet. The most important role played by these statements is they give an idea or they represent the financial status and evaluate the performance of a company. So if you want to know the financial position of any firm or a company, the income statement or the balance sheets can give you a clear picture of the financial status of the company. So let us start with studying income statement. It is also termed as profit and loss statement or fund flow statement. So income statement is a summary of revenues, expenses and resulting profit or loss of a firm for a stated period. Generally, we have an income statement in between two balance sheets. Balance sheets are produced at the end of a financial year, whereas income statements are generated as per the requirement. For example, we can have an income statement at after say a quarter span of the year, that is after 3 months, or we can have an income statement at an half yearly period, that is after 6 months. Okay, so income statements can give the financial status of a company for a particular period, and in civil industry this become very important because in civil industry the flow of the work changes with the season in many cases. Okay, so that's why the income statements plays an important role in construction accounting. It permits to track the performance of a firm during the stated period of time. So the most important terms of the income statement we will be going through now. The first term is operating revenue and operating expense. Next terms are non-operating revenue and non-operating expense. So operating revenues. So revenue means earning, expense means spending. So whenever you come across a term revenue, you have to take a plus sign. Whenever you come across a term expense, it is to be subtracted. So operating revenue is the total profit which you will be getting by completing of the given task or by completion of the given work. Whereas for doing that work, whatever materials you require, labors you require, okay, machineries you require, everything for which we have to pay comes under operating expenses. Whereas non-operating revenues are the ones which are not associated with your core work. if your firm say has an investment in the form of a say FD, so from that you will be getting annual interest. So that becomes a non-operating revenue. Similarly, if your firm has taken a loan for a project work or for some other thing, you have to pay the interest periodically. That becomes an non-operating expense. So friends, remember here the four important terms: non-operating revenue, operating expense, non-operating revenue, and non-operating expense. So together, when we take all these, we come to the term profit or loss. So what is profit? The excess of revenue over your expenses makes a profit. For example, say if your revenue, that is the money earned, is 10 lakhs and your expenses are say 7 lakhs, that means you have gained a profit of 3 lakhs. Whereas on the other hand, if the expenses are more than the revenue, then your firm is under a loss. For example, if your revenue is same 10 lakhs, that is the money earned, whereas your expenses are say 11 lakhs, that means 1 lakh you are spending above your revenues, which is a loss. Hence, it is also termed as a profit and loss statement. So let us check an example. Say we have just taken a random company, and this is with respect to the March end 2019. So operating revenues, this particular firm is getting an operating revenue of 4 crore 52 lakh 60,700 rupees. That means what all works that firm is doing, by doing that it is gaining an operating revenue. For that, what it has to do, it has to spend. That is termed as operating expense. Now where generally a civil industry will spend? First on equipments, then on materials, then on labors, and say if a work is big, they give it as a piece contract work to a subcontractor for whom they have to pay. So these all become operating expenses which are required to get the work completed. Hence these all will be with a negative sign. Therefore, total operating expense will be operating revenue minus of operating expenses. Therefore, that becomes your gross profit from the operations. Okay, that means your operating revenues were something 4 crore 52 lakhs, but when you have subtracted, when you have subtracted your operating expenses, you get the profit of 1 crore 13 lakh 65,250 rupees. Now, this next comes the term general and administrative overhead cost. Now, these are the costs which we have to bear for say if you have set up an office, you have to pay the electricity bills, you have to pay for the fuel of your vehicles, or some office works are there, or say if you take testing of the materials, etc. These all come under general and administrative overhead cost. So guys, you have to be very careful while managing this cost, because it can cause a lot of damage to your income statement, because it is again with a minus sign. Next comes, when we subtract this general and administrative overhead costs from the gross profit, we get something which we call as net profit, which has come out to be 67 lakh 3,450 in this case. Further, we'll come to the next part, that is non-operative revenues. That is, these are the revenues earned by the investment of the company. Say for this period which we are considering, the non-operative revenues are the interests which are received. They are about 7,69,500. Similarly, non-operating expenses have come up to be 4,07,850. Therefore, we get profit before tax. Okay, that is net profit from operations plus non-operating revenues minus non-operating expenses. Further, we have taken a tax of 3%. Therefore, the net profit after tax is 49 lakh 45,570. Now see the huge difference. The operating revenues was somewhere 4 crore, whereas the net profit after taking out all the expenses has come up to be 49 lakhs 45,570. So this represents one income statement. So the calculations which I said are shown here. Go through this and please pen them down. We can give you an example on this in the internals. Now next comes the most common term which we have heard. That is a balance sheet. It shows the details about the financial status of a firm at a particular point in time. Generally a balance sheet is taken annually or financial year wise, which here we have from April to March end. A balance sheet is a summary of firm's assets, liabilities and owner's equity or net worth. Okay, so the most important terms in a balance sheet are assets, second is liabilities, third is owner's equity or net worth. It can be prepared at any time interval, quarterly, semi-annually, but most commonly prepared at the end of the financial year. So friends, let's start with the terminologies of the balance sheet. First term which we have to study here is the assets. These are the resources of monetary value which are owned by a firm or a company. These include cash, plant and equipments, land, buildings, construction materials and the receivables. Receivables is the payments which you are yet to get from the market. Assets here are classified into two types: current assets, long-term assets, and the third category is other assets. Current assets, these are defined as the assets which are likely to be converted into cash within 1 year. So you can classify the equipments, okay, which are smaller, or say vehicles, under the current asset category. Current asset means it will be liquefied in a year span. Okay, so if you have a small piece of land somewhere, that becomes your current asset because in a year you can sell it. Whereas long-term assets are those which cannot be readily converted into money or cash, and these assets provide future benefits. For example, you have taken office space. Okay, you have purchased office space. So it's very likely impossible that within a year you will sell that space because there you have made all the setup and you are working there. So that something becomes your long-term assets. Say you have a bungalow, you have constructed a bungalow, okay, and you are staying there in that bungalow. So that becomes your long-term asset. You have set up a big plant, okay, you have set up a big RMC plant. That becomes your long-term assets. So understand this difference between current assets and long-term assets. Then third one is other assets, which includes investments in other enterprises. Okay, so other assets can be your investments in the form of shares or mutual funds, etc., which are your other assets. So you have three types of assets: current assets, long-term assets and other assets. Current assets are the ones which can be converted into cash easily, or say maximum in 1 year span you can convert it into cash. Long-term asset is your long-term investments which you cannot convert it readily, but from future point of view they are very important, whereas other assets are your investments. So for example, when we take your own student example, current asset is what you are studying now and how will you utilize. The knowledge gain becomes your long-term assets because this you will be using throughout, and other assets is the more information beyond the course or say extra learning what you are gaining becomes like an other asset. Then comes the second part, liabilities. Liabilities are the payments which you have to make. Okay, it includes the bank loans, the money which you have to pay to the subcontractors, okay, or the advances which you have taken from the owner, which you have to pay back taxes, etc. comes under liabilities. Liabilities in short means what you have to give. So again there are two liabilities, one is current liability, second is a long term liability. Current liability represents the obligations which are likely to be paid within a year, whereas again long term liabilities are the ones which are debts and they are not cleared within a year. For example, current liabilities. Now when you take a rent becomes current liability. Monthly you have to pay the rent. Okay, so if you travel in a vehicle, as soon as your journey ends, you have to pay the money, or sometimes you have to pay the money in advance. So those all things become current liabilities. Those things will be paid off in a year span. Maximum is a year span, but maximum current liabilities are paid off then and then there where the service is taken. Whereas long term liabilities are something such as the loans taken for a longer duration. For example, housing loan. We don't take a housing loan for a year. That comes for a term minimum of 10 years and beyond. You have 10 years, 15, 20 years. Okay, so that becomes your long term liability. Your vehicle loan, which you have taken for 4 years, 5 years, that you can classify under long term liabilities. Secondly, if you have set up a big business, okay, big plant you have set up for which you have taken a loan, or investors have invested money in it which you have to pay back in further years, those all become long term liabilities. Okay, so as a civil engineer, current liabilities, handling of current liabilities becomes very important, especially if you are a site engineer, because all the expenses which are occurring have to be managed by the site engineer. Hence these all financial terms are very important. Next is owner's equity or net worth. It represents the excess of assets of a firm over its liabilities and is recorded on the balance sheet. It consists of three components, namely common stock, preferred stock and retained earnings. So what you have as an asset which is extra than your liabilities, it becomes owner's equity or net worth. Okay, it becomes what? Owner's equity or net worth. It is divided into three parts. Common stock, which represents major source of investment by the stockholders in the company and provides the stockholders with voting rights to exercise in a company. Preferred stock, this is the same investment, but in this case they may not have the voting rights, but they get something called as a dividend. That is, a percentage of profit of the company goes to them in the form of a dividend. This dividend is a common word with the societies which we have in and around us, the small banking type societies which we have, they give us dividend. Then retained earning represents the profits or earning which are reinvested in the company rather than distributed as dividend to the stockholders. These earnings are retained by the company to reinvest in business and to increase the income. So retained earnings is a very important concept. Now if you are the owner of the company, you get profit. What you do with that profit? Okay, either you can spend the profit or you can invest that money for the growth of your company. If you invest that profit for the growth of your own company, it becomes something called as retained earning, because that is the profit earned from the same firm which is being put back again in the development of the same firm itself. So these are classified under owner's equity or net worth. So last, what is assets is liabilities plus owner's equity. So generally, if your assets are more than liabilities, you are running smoothly. But if your liabilities become more than your assets, then these are the standard cases which we are seeing in our country. Okay, so these terms are a bit different, not that easy to understand. Hope you all cope up with it. Again, once we get back to the classroom, I will revise these things. Secondly, I'm telling you all that This subject requires extra reading and common sense. Just if you get up and if you say that I want to understand construction economics and finance, it is not possible. So these all terms which we have used are not your technical civil engineering terms. So from your side you have to put a bit of more effort, read the things, contact the concerned faculties and cope up. So let's conclude with today's lecture. Thank you.